Hello, everyone. My name is Philip Palumbo. I'm the host of the Palumbo podcast, where we interview some of the smartest investment managers, macroeconomic economists, and market strategists. Today, I'm super excited to have with me John Nersesian. John has 42 years experience in the investment management and wealth management space. He is head of advisory education at PIMCO, which is a multi-trillion-dollar investment and asset management firm. He's an instructor for an investment management program at Yale and University of Chicago. And he also spent 20 years of his career at Merrill Lynch on the private banking side. So, John, I am really excited for numerous reasons to be talking to you today. So thanks for your time today.
It's my pleasure. I love this topic, and I love working with great advisory firms like yours to help bring some of this to the end investor. So thanks for the opportunity.
Yeah, no, my pleasure. So I want to tell you why I'm excited about this, right? So, as my clients listen to this and prospective clients and family and friends, investment management and psychology behind investing is the most important aspect of investing to really understand. And if you get it wrong, you and I know, John, I've been doing this for 23 years, you're in this for 42 years. People make significant mistakes. And literally during tough times like today, where you have market volatility, you have interest rate volatility, which is something we're not used to, where rates are going up, bonds are getting hurt. So there's a lot of educating that I'm doing with clients to keep them on their path, right? And on their path that we agreed to from the beginning together as a team, so they can succeed and not run out of money at some point down the road. That's the ultimate goal of what I'm trying to achieve for my clients. So John, when you spoke during the Pershing event, you spoke about behavioral finance. Mm-hmm. And so what I want to start off with is you explaining to the audience, what is behavioral finance?
Yeah, great question, Phil. So we're all familiar with traditional finance, and you, I think, did a really good job of introducing that a moment ago. So traditional finance is, I'm an investor, I go to a great firm like yours for general financial counsel, and you're going to tell me how to allocate my assets. You're going to tell me where I need to be in terms of interest rates in the yield curve. You're going to help me develop a financial plan that accumulates money and distributes it once I get into a retirement. And all of that is incredibly important. All of those great capabilities that your firm brings to the table are all going to contribute to my long-term success as a client. But there's a second ingredient in this equation, one that many of us kind of ignored or weren't aware of in the years past, which is forget about all the financial tools. The question is, how about us as individual investors? What are our behaviors? I can give you the very best tools and resources, but if I don't use them correctly, if I make poor or what I call suboptimal decisions, then the best tools and the best laid plans often go to waste. And so I think you've hit on something really important, not just this understanding and awareness of behavioral bias, but also the really important role that a great advocate, a great partner, can play, a great advisor can play in leading us down the right path.
Behavioral finance, right? It's you're right. So you can show clients all these different tools, which we do, and you can show them all these great charts, which we do, and you can educate them about the history of markets and how it's important for diversification being a long-term investor. But it's an investor's behavior that could really hurt them in terms of mistakes, right? So in your experience doing this 42 years, and as we speak about behavioral finance, what are the top issues that you see investors make?
Yeah, great question. Thank you for, once again, reframing this idea of traditional economics versus behavioral finance, right? Traditional economics looks at markets and opportunities and makes theoretically rational choices. Behavioral finance, Phil, is this idea, and we don't mean to sound critical, by the way. You and I are not critical guys.
Right.
Behavioral finance says, wait a minute, we are all emotional human beings.
Right.
And these emotions and these tendencies and these biases, some of them conscious, some of them subconscious, this baggage that we bring into the equation can lead us, unfortunately, to make incorrect decisions. And so that's the premise behind it. What are some of the common biases? We see them every day. Number one, how about overconfidence? It's the idea that we think we know what's happening and can predict future returns. How many of us have kind of engaged in some financial activity with that sense of confidence behind us? And by the way, I'm not being critical of our abilities. I know the clients you work with are very intelligent folks. They're very bright. They're very successful at what they do. But markets have a tendency to perform in a way that is very difficult to predict. And so one of the obvious biases that we all face is overconfidence, the idea that we think we're actually better at making these predictions than we are. Let me give you a second one in addition to overconfidence. How about recency bias, Phil? It's the idea that we are enduring current market volatility and we don't look backward and examine all of the past data points that might influence our decision today, Phil. What we have a tendency to do, I don't know if it's laziness or simply the premise that some of these data points stick in our brains and our memories more effectively than others. We only look at what happened recently. We assume that the current trend of the day is one that will continue into the future. So the market's going up this quarter and it's like, oh, that feels pretty good. And I'm going to assume that the market will continue to go up. Or whatever the behavior might be, it's the idea that we have a tendency to ignore the long-term data and opportunity set that should influence our decisions, but we assume that the trend that is afoot today will continue indefinitely into the future. Markets go down, we get nervous, we sell. Markets go up, we get greedy, we buy. And we sometimes lack that rational approach to long-term decision-making.
I think that's a really, really, really strong point and really important for everybody to understand, right? It's the idea of this overconfidence, which is you believe a certain trend will continue indefinitely. An example of that today is interest rates.
Yeah.
Right? Where are interest rates going? I have no idea. You have no idea. I could put the smartest people at PIMCO together and they can come up with a great idea of what they think, where they think things are going to go. And so can I. But in the end, nobody knows, right? Mm-hmm. But because of that, but people think they're so overconfident that, well, rates have to go up because of inflation and because the debt we have and the deficits, et cetera, right? Which maybe that's true, right? And maybe that comes to fruition. However, nobody can predict that with complete certainty. And if you read Bob Farrell's rules, I don't know if you know Bob Farrell of Merrill Lynch, right?
Very well.
Yeah. Oh my gosh, incredible rules he has. One of it is that everything reverts back to the mean. Everything reverts back to the mean. So if you look at rates right now, there's such a gap from where the trend is to where it is, that one must think that at some point that's going to happen. So, John, the way I always summarize behavioral finance for me is two ways, two emotions that are going on, right? There's either the fear of missing out when things are going well, or the fear of losing everything when everything's going down.
I like
and it goes
that.
back to what you said, this overconfidence that when things are going down, you believe it's just going to go down indefinitely, and same thing on the upside, which your point is not the case. And just the second thing I want to say quickly and move on to the next question.
Sure.
Is you use the word intelligence, right? Many of my clients, many people you work with, every single one of my clients is very, very intelligent. Mm-hmm. And one most of the time thinks that intelligence equals I know what I'm talking about as it relates to investing, right? And the reality is unfortunately, it's not really the case. In fact, that what normally happens is the opposite that you're thinking. So whatever your gut is telling you, it's the opposite. Normally is how things play out, right? If you think about going into this year, everybody was negative, recession. I was in that camp as well. And what happened? The complete opposite. No recession, markets rallied the first half, right? And we'll see what happens second half in 2024. But all really, really good points. So moving on as it relates to behavioral finance and some of the key common mistakes like you just alluded to. Why do you think people react in this magnitude where they're making wrong decisions at the bottom and making wrong decisions when things are going well? Why do you think they're doing that?
I love your question because we identified some of the mistakes that we make. The question that you're now asking is, why do we make them? I mean, theoretically, we're not doing them to intentionally harm our financial outcomes. We're not doing them because we're not intelligent people who are capable of making rational choice. It's often the way in which our brains are wired, Phil. Here's the deal. So once again, traditional finance says, wait a minute, you're very logical. You look at all the information that's before you, you synthesize it correctly. If you were a computer, you take a look at all this data and you would come up with probabilities and reach what we call the optimal decision. No guarantee, but you're stacking the odds in your favor given the evidence before you. As individual investors, we don't necessarily absorb or process information that way. We process information in a suboptimal way that leads us to incorrect conclusions. There are two components to the human brain, right? You often think of it as left brain, right brain. I refer to it as intuitive versus reactive. It's the idea that, wait a minute, intuitively, I think I know what I'm doing. My decisions are governed based on the way that I feel, right? The more rational approach is I would make decisions using a more analytical approach. And unfortunately, for a variety of reasons, maybe because it's easier, maybe it's happening subconsciously, maybe it just feels better, and therefore we let those feelings guide us in terms of the decisions we make. We don't make the decisions that are often in our best interests. So once again, it's not our fault. It's the way in which we're governed. It's also, to your point, it's the challenge of financial markets. If we knew what was going to happen tomorrow, the allocation of resources and successful investing would be easy.
Right.
But that's what investing is. Investing is dealing with uncertainty.
Right.
The idea that we may have an inclination or a thesis of what we think may evolve, but the reality is that there is no guarantee. And so I use this phrase, maybe it's one that you would embrace as well, which is successful investing is a counterintuitive process.
That's right.
Successful investing is counterintuitive. What did Ted Lasso say in season 1? If it feels uncomfortable while you're doing it, then you're probably doing it right.
That's right.
And so what's the premise is that markets are going down. That doesn't feel very good, but maybe that's when we should be adding to our exposure because we're buying low. Markets have rallied. Everybody's excited about the returns that they've already made, but by definition, prices have already risen. So being a successful investor often encourages us or requires us to be kind of counterintuitive. I know it's really hard to do it as an individual. I think that's probably the reason that I benefit from some tried and true methodologies, some best practices, if you will, that can shift the odds to my favor. And we'll talk about those, I think, during our conversation.
It's like in life, right? You have to get comfortable with being uncomfortable. It's just like sports, right?
I like that.
If you're participating in sports and you're in practice and you're pushing hard and it hurts, but if you continue to push harder and harder and harder and you break through that threshold that's uncomfortable, that's how you break out to the next level in that sport that you're participating in. It totally is exactly, that's just the way it works when it comes to sport and life in general, whether it's a business, but investing even more so, because when you are uncomfortable, so like you think about this, right? This way, like in your presentation that I have in front of me, we review this with clients as well. When you look at the history of markets, we've been through the Persian Gulf War since 1990, the dot-com bubble, the Iraqi War, September 11th, the Iraq War, September 11th, global financial crisis, sovereign debt crisis, fiscal cliff, Brexit, pandemic, the inflation, Ukraine war situation. What have markets done the whole time? Gone up, right?
Phil, are you trying to depress us with all these negative experiences that you're reminding us of? What's your point here, Phil?
The point is that markets gone up. If you look at the returns, they've averaged, 10% plus, even through all of that. And as much as that we show this to investors see this, they still make these mistakes that we're talking about. So a lot of investing is you have to have also faith in the economic system of the United States of America. That's so important. And understand that we've been a leader through and through, whether it's automobiles and TVs, through the internet. Now it's artificial intelligence. We have the best companies in the world. So, and just the last point I want to make to this is that, one of the key things, like you said, is when certain asset classes are depressed, whether it's stocks or bonds or gold or commodities or private equity and real estate, right? It's uncomfortable to add that risk at that point, but that's the right time to do it because you're buying it. You're buying it what? You're buying low. And that's what I tell people all the time, John. Don't tell anybody. My secret is buy low, sell high.
Now you tell me, Phil. Thanks a lot. Where were you?
After 42 years, you finally learn what you're supposed to know. But seriously, like that's really, really important as we think about the process.
I want to go back to those events in history that you referenced, because I think you bring up a really good point there, Phil. The point was not to identify all of these tension-filled moments that all of us have endured.
Right.
It's to go back and to learn from them. So many investors during those experiences, Bay of Pigs, Persian Gulf crisis, whatever it might have been, would have used those events at the time as a rationale or an excuse to abandon their strategy. But what history has told us, and I know this is your point, is letting emotions govern your long-term decision-making. It would have been the wrong move at the wrong time. And so the point is not necessarily to ignore the events as they're unfolding or to ignore the news of the financial day. The point is to understand what you're going to do with it. and how it might influence your current decision making and your emotional response. Good point.
Yes, I agree. And, as I think about investing, what I always say to myself is there's always so much money that's out there that they're looking to deploy that capital and get a certain investment return on that capital. So when markets come down to a certain level, both on the equity side, or it's real estate, or it's private businesses, right, or bonds come in at a good value from a risk-adjusted return standpoint, the big institutions are going to step in and take advantage of that and be that floor, underneath the overall economy, and that's what keeps things alive. But John, so so let's just say someone's listening to this episode right now, and they're saying, I get what Phil and John are saying. I get the history of the world and where we were, where we are today. I get that. However, we have some of the largest debts that we've ever seen, right, since post World War II, and our deficits are very, very wide right now, right? So people may say, hey, John and Phil, but this time it's different. What do you say to somebody who feels that way?
Well, I would never negate an investor's concern. So one of our jobs, Phil, is to demonstrate empathy and to ignore the client and to say, listen, all of the concerns that you're bringing to me today are invalid. Well, you can't invalidate my feelings.
Right.
If I feel concerned, if it's something that's keeping me awake at night, you may agree with it, but you may disagree with it, but you can't dispute its existence. Your job is to recognize that and then to take those concerns and then to maybe help me make decisions based upon them. And so what I would suggest is this idea of kind of learning from history. We've had other points in time where we've been concerned, where we've thought that the best move was to abandon strategy or to engage in some sort of tactical approach. And more often than not, Phil, as the evidence suggests, that works against us, not for us. I know you have the study in front of you. Morningstar did a study, Dalbar did one of similar nature that looks at the return of the market and the return of the investor. And there is a gap. Carl Richards, who wrote a really good book on the subject, calls it the behavior gap. That the market over the past 20 years has averaged about 11% a year. The average investor in that asset class has only averaged about 9.3. There's a 170 basis point difference between the two. And what has led to that gap? It's not intelligence. It's not opportunity. Oh, I wasn't afforded ample opportunities to deploy my capital to earn those returns. It was our behaviors. It was the individual investor who says, well, wait a minute, this time things are different. The concerns that I have today are really going to lead to a different outcome. It's engaging in market timing. And unfortunately, maybe there are some who can do it well. Market timing often works against us as opposed to for us.
Yeah. An example of that is, today's environment, like I said, rates going up and certain bond investments are going down. And it's like we talked about before, it's clients are thinking, hey, when is this going to stop going down? And how much rates are going to continue just to move higher, when we do know that, rebalancing into that asset class, we don't know if today is going to be perfect timing, but we do have a pretty good idea in 2-3 years from now, that's probably going to be the right move to make. But yet, clients are resistant to do that. But you do have to have empathy. You do have to listen to them and give them options. But the key thing is, as an advisor, and I really do believe, and we're going to talk about this, one of the best values I can bring as an advisor is avoid my clients from making stupid mistakes with their money.
I love it. So
they can stay on track for what we're trying to accomplish together.
I think that is so great. What I often hear from the retail crowd, from the investor crowd, and I appreciate the due diligence, the questions that they ask, the confidence they need to have in their relationship. What I often hear is, gosh, John, what's the cost of this relationship? What is the fee that I'll be paying to my advisor? And I often respond with a somewhat glib verbiage. I don't know if you'd agree with it or not, which is the greatest cost to today's investor is not the modest fee you pay your advisor. The greatest cost to the investor is the costs of the mistakes they would make without the qualified help.
Exactly. Yeah. And
I know that that's what firms like yours do such an exceptional job of doing. If I look back at my own behaviors, and once again, it's not because I'm not intelligent, it's because I lack experience. I'm maybe too emotionally connected to my money. I lack that objective perspective that a great firm like yours can bring to the table. because of that, left to my own choice, I will often make decisions that feel good necessarily, feel right, feel comfortable, but ultimately are unproductive.
That's right. That's right. To go into cost of hiring a financial advisor, right? And I don't want this to make a commercial about a financial advisor and why people should hire me or other advisors out there. We just want we want to give them facts so they can understand and be educated about that, right? So we just talked about the cost of the mistakes that investors make and what it cost them, which is 170 basis points, right? Mm-hmm. We just talked about that. I mean, you have this one of your charts here where over a 10-year period, as of December 31st, 2021, going back 10 years, the investment return was 11.04%. The average investor, they received 9.31. There's that gap that we just talked about, right?
Right. Those are the numbers. Yeah, you got them.
Yeah. And then 3 independent firms, Morningstar, Vanguard, and InvestNet. InvestNet works with advisors. You can maybe say they're biased, right? But let's use Vanguard and Morningstar.
Sure.
They studied advisory firms. And what they studied is factors where they saw increased value that an advisor could bring to the table. One of them is avoiding mistakes, like we just talked about with that study. 2 is tax efficient withdrawal from their portfolio. So when they withdraw money to live on, where's the best place to take it to create efficiency? Asset location, right? So where can you put certain assets where it's more tax efficient? Allocating the portfolio, behavioral coaching, and all of this. When they summed it up, is the advisor this adds about 1.5% to as much as 3%, according to Vanguard, right, per year in value that an advisor can bring to the table. Can you elaborate a little bit more on this, or maybe whatever you think is best to educate people about?
I'd be glad to. I think you bring up a really interesting point. So the question that one might be asking is, okay, John, why should I hire an advisor? Or if I do hire an advisor, what are he or she going to be able to add to my equation, right? So there's got to be this value, Phil, in any relationship. I don't care if I'm hiring a contractor to redo my house or I'm hiring another professional to provide a service to me. I think what we're all looking for is value. Now, value in my world is the intersection between the costs that I pay for that opportunity against the benefits that I derive. It's not singular. I don't simply look at the benefit. I don't simply look at the cost. I look at the two of them in concert. I look at them together. And I have to make that comparative, if you will. Are the benefits that I'm able to derive from this relationship, what do they look like relative to the cost that I pay for being able to access it? And that's the value equation. That's right. I'd like to think that advisors add value in many ways that are probably obvious to you, but aren't always obvious to the investor. They're assuming as that financial advisor at Palumbo, they're going to help me allocate my portfolio. They're going to tell me whether or not I should have more stocks or bonds in my portfolio. And look, investment guidance, right? I sell my business or I retire and I've got this capital to deploy. I know that you can help me with a sensible investment approach. Right. And that methodology, that process that we use together to allocate my resources in a way that delivers the return I want with the level of volatility that I'm willing to accept, very valuable to me. But that is short-sighting.
Yeah.
Great things that a firm like yours can do for the client. How about tax efficiency? How about retirement distribution? Phil, I'll give you a perfect example. I'm 65 years old. I know my beautiful suntan makes me look much younger, but I'm 65 years old. So I'm thinking about retiring, okay? And I'm a financial guy, right? And so when I retire, there are 2 things I want to accomplish in this world. Number 1 is I need to make sure that my money doesn't run out. It's got to last as long as I do. But the second thing that I want in that equation is I want to be able to enjoy the wealth that I've accumulated as well. And you realize, Phil, because you're great at this, that the 2 are diametrically opposed. And so how does the investor, and I don't mean this critically, I really mean it as a fair, objective question. How does the investor come up with a distribution policy that accomplishes both of those 2 goals simultaneously? What is your approach to distribution? What is your approach to asset allocation when you retire? How are you going to minimize taxes? How are you giving money to charity? You're writing a check. Are you contributing appreciated property? What is your thought process regarding the realization of gains or losses in your portfolio? The financial landscape is so much more complicated today than it was when I started 40 years ago.
Without a doubt.
And the needs of today's wealthy families are more complex, more varied.
Right. Yeah. Yeah.
And so this is not an easy process. It requires time and energy and effort. And that's the value I think that you're referring to in this relationship. The ability to access somebody who's not only emotionally dispassionate, who can help me make the intelligent emotional choices that I need to make, but also brings a sense of acumen to the table that allows me to solve for and make the very best financial decisions for me and my family. I love your comment.
I agree with this. So it's like when I read this from, I remember Vanguard. They came up with that first, and they broke down in great detail everything, right? And then I thought about a particular client. I'll just tell you a quick story, right? So, client of mine, he had an estate tax problem, right? An estate tax problem. So we met with an attorney. Attorney proposed a certain strategy called a slat, which was terrific, made total sense.
I have
would save the client a ton of money. Okay, terrific. So we went home. Client called me up and said, "Phil, I'm not paying the attorney $8,000. Could you get it for something less?" I said, "Let me see what I can do." Called the attorney up, right? Called him up, said, "Hey, my client wants some less, etc." He said, "Listen, Phil, I'll do it for $6,000, no problem." Call back to client. "I got it done for $6,000. Let's get over there like yesterday and get this done." He's like, "Okay, let's go. Go to the office, get it done, etc." Client died, no joke, 7 months later, right? Great client. I saved the client's family $400,000 in state taxes. So like that's return. I didn't go to the family and say, "Hey, by the way, here's the return of your portfolio, and I saved your family." I never even said to the client, not for any particular reason, but when you think about that, that's that extra 2-3% that they're talking about per year that an advisor can bring to the table.
Right. I love it. I think mistake prevention. So what is it you do for a living? And I know many advisors answer this question differently. Well, I help people make complicated financial choices that, improve their outcomes of successful results. I help my clients simplify the stress of managing wealth. I like your verbiage, which is my job is to help clients develop a strategy that's consistent with their circumstances and to minimize the mistakes that we would often make given the emotional and financial complexity of the world that we live in. It's good stuff.
Absolutely.
Good stuff. Now, if you're delivering that, that's great. The question is the advisor actually delivering that? And I'd like to think in this evolved world that they are. Now, the problem, once again, is the average investor may not necessarily appreciate or understand that.
Right, exactly. And I think most advisors, according to J.D. Powers, they're not providing that services, as that's what the studies have shown. But I think more and more are trying to, as we think about things going forward.
Buddy, that's what I do for a living. You referenced the 2 classes that I teach, University of Chicago and at Yale. What am I doing there? I mean, I like teaching, but the reason that we're doing these classes, the reason that what are we all doing? We're all trying to improve our skill set, our knowledge, our competency, so we can meet that very significant responsibility or expectation that we've all agreed to accept. Yeah. Which is my job as your financial advocate, is to help you make the very best decisions that allow you to enjoy your wealth and achieve better outcomes.
Absolutely. You talk about in your presentation, and this could help people understand when investments are declining, how people are feeling. And then you call it loss aversion, which is pain of losses are 2 times as painful as the pleasure of gains. Yeah. Right. So the pain of, I want to say this twice, the pain of losses are 2 times as painful as the pleasure of gains. Right. For me, as an advisor, I have a big focus on downside risk.
Good.
Because of this, right? So just talk to me, a little bit about this part of your presentation.
Yeah, let's talk about this premise of loss aversion. And by the way, my buddy Richard Thaler, who teaches at University of Chicago, he won the Nobel Prize for his book with Cass Sunstein called Nudge. We do a lot of work in this area of loss aversion and many of the other biases that are commonly faced by the retail investor. Loss aversion is one of the strongest. And I know that many of our friends who are viewing our podcast today can relate to this. So stop and think about this. I'm an LA Charger fan. Go ahead, criticize me if you want. Make fun of me. We've never won a Super Bowl. So I go ahead and I bet $100 on the Chargers game this weekend because gambling is now illegal, apparently. And so I go ahead and I bet $100. If the Chargers win and I win $100 for my bet, they beat the Vikings by 4 points, I think, over the weekend. Okay, I win $100. And that makes me feel pretty good. I'm glad about that outcome. If I bet the $100 on the Chargers and they lose, I got to tell you something. The pain that I endure in that loss of capital is greater than the joy that I experienced from a winning bet.
100%.
And there's probably a reason behind it. One of it may be called the endowment effect. Look, if I miss an opportunity, I don't follow your great advice, Phil, and I wind up staying in cash and I miss the next market opportunity, I underperform because of my conservative approach. The rationale that I'll use is, well, nothing ventured, nothing gained, but I didn't lose anything, even though there was an opportunity cost of my decision. And for that reason, investors have a tendency to be ultra conservative. It's this emotional response to losing capital that often drives their investment decision making. Phil, I bet you've owned securities for clients that didn't work out the way that we had hoped and that were underwater. I bought Zoom stock at 70. The stock's trading at 60. Maybe it no longer fits in my portfolio. Maybe there are better opportunities for me to redeploy my cash. But the investor's response in this hypothetical scenario is, John, I can't sell my stock at 60 because I bought it for 70. Selling at 60 would be booking a loss, and that's just something I don't want to do. And so what does the investor do? They wind up compounding their problems. They wind up letting that loss aversion distract them from the productive financial choices they should be making.
Absolutely. So this idea of loss, it depends how you define loss. And I'll give you an example of this, which is really, really important. So my grandfather, when he retired from Con Ed as a boiler worker at 65 years old, he had $300,000 in Con Ed stock. It would give him his dividend of 5%, 6%, which was enough cash flow they needed plus Social Security. However, every month my grandmother used to look at the statement from where they had Con Ed stock in, and obviously there would be fluctuations. And my grandmother always on a Sunday, and we're Italian, so we used to have dinner around 1:00. My grandmother used to say to my brother and I, who were in the business, and with my grandfather there, and said, why is my stock going down? I lost $15,000 this month. My grandfather always said, and I swear I never forget this. My grandfather said, Millie, you didn't lose anything. You don't lose until you sell.
Right.
So when you speak to clients also oftentimes will say, I just lost 50 grand, or I just lost 100 grand. And you didn't lose. The value of your investments are down, but you didn't lose. So one thing, what I want to talk about next, John, right, is this idea about risk and how you think about risk and how one thinks about losses. I would argue that the biggest risk that people are exposed to, my clients specifically, are people at the point where work is optional, retired, whatever it may be. Their risk is the risk of them running out of money. I don't care if you retire with 2 million, 5 million, 10, 20, 50, $100 million, because spending really matches up to the level of assets you have, right? So if you're overspending and you're taking a withdrawal from your assets of 5, 6, 7, 8%, you're going to run out of money. So even though that we have to manage this idea and concept of risk and loss, clients do have to understand that, just like anything else in life, if you want something great, which is you being able to continue your lifestyle, you're going to have to go through some pain with investing in order to get there. And the pain is when economies go down and go through recessions, markets go down. That's the pain I'm referring to. So if you can, how do you think about risk? How do you think about losses as I just explained it?
Yeah, it's a really good question. I love the way that you're reframing this issue. So how does the investor define risk? Many investors say, well, wait a minute, I buy a security for 100 and it goes to 90. That's risk. I've lost money on that one investment or at that one moment in time. But I'm going to agree with you, Phil, that that's maybe not the best way to think about risk. What is my risk as a 65-year-old? Risk is not whether or not my portfolio is up or down in a given year. Risk is not whether or not every investment I hold winds up trading for a price greater than what I originally paid. Some of them may be down in value. That's part of the equation. Risk is what? My inability to achieve my financial goal, my inability to be able to retire, my inability to spend money once I have retired, my inability to leave resources behind for that next generation. So let's redefine risk in a way that I think is more useful to the investor. Risk is not this premise that I allocate capital today based on your recommendation, and 3 months from now, it's trading for something slightly less than what I paid. That's volatility. And I will argue, Phil, that volatility that so many investors are uncomfortable with and so many investors avoid, volatility or risk, believe it or not, is a good thing. And here's why. Risk is the price I pay for the opportunity to earn higher returns.
Right.
You want to avoid that volatility? Take all your money and stick it under the mattress.
That's
Go
right.
ahead and buy CDs with it.
That's right.
The question that I would ask you is that a path to a successful outcome? After I pay taxes, after I account for the impact of inflation,
right,
when I look at the rising cost of my living or expenditures later on in life, it may feel like the right or the riskless way to pursue financial activities, but it doesn't necessarily immunize me or protect me against the risks that are most important in my financial life.
And I would argue that your risk is higher that you run out of money in that type of scenario, unless you have a lot of money and your expenses are ultimately low, which is something you have to do through analysis and financial planning. And I get that, and that's perfectly fine. To piggyback on what we're talking about, and this is a really important part of the conversation. Oftentimes when markets are volatile, I'll have successful business owners who own a business and own real estate will call me and say, Phil, get me out of the market, because they're concerned. And I would often say it to them sometimes, depending on how I'm feeling. Well, are you going to go sell your real estate investments right now?
Right. Are you going to sell your business right now?
Are you going to go sell your business right now? And the answer is no. Then why are you selling your investments of stocks of great businesses like Waste Management, Johnson & Johnson, and Pfizer, and Nike, and all these great businesses we own in a portfolio, and Microsoft, and you go on and on and on. Why are you selling these great businesses that are throwing off great free cash flow, just like your real estate and your business is doing? Why would you do that? Because you can. So I always say people all the time, real estate people, if they had the opportunity to sell their real estate on an open market like you can with stocks, there's no way these people would be as successful as they are today. It's the illiquidity of it and the inability to sell on a dime is the number one, and it's an asset that has averaged over 10%. So you're in a risk asset that has produced these great compounded rates of return. But the stock market, it's this ability to be able to sell on a dime or buy on a dime, and the volatility of it that throws people off. So just, this is a really important point. I'm wondering your thoughts about what I am saying. As it relates to these investments.
I appreciate your comments. So I'll address two components of it, Phil. Let's talk first about liquidity, and then let's talk about returns and how they're produced. So liquidity, the question I ask is, how liquid do you need to be? And when is excess liquidity, instead of, I know that it may provide some sort of psychological comfort, but when does that work against me? And the liquidity in markets, in fact, some would argue that the illiquidity that is afforded to investors in certain transactions, whether it's real estate or private equity or other types of investments, sometimes that protects us against ourselves, right? It doesn't allow us to commit that knee-jerk reaction to short-term volatility that often leads us astray. The other thing that I'd like to point out, which is the returns, whether it's real estate or owning a business or being invested in great stocks that you've referenced, what investors need to accept is that greater return that is available through these productive investment vehicles, it isn't earned consistently. It's the price of admission. If I get 10% on average from stocks, that doesn't mean that I'm getting 10% every year. It means that in certain years, I'm going to enjoy better returns. In other years, my returns will be below that number. But over the long term, that's exactly what my opportunity set is. So do I want to sabotage the opportunity to earn those higher returns by getting in and out of the market? And the question I would ask rhetorically is, are those tactical decisions of getting in and getting out, are they adding to my returns, or are they ultimately harming the returns that I'm able to produce?
And most times they're harming that.
Well,
excellent. So long-term investing, right?
Yeah.
I produced a video on Invest Like the Best, and in there I talk about Warren Buffett, right? So when you think about the GOAT of investing, it's Warren Buffett. The GOAT of football, as from a quarterback standpoint, or just the best football player ever, is Tom Brady, and golf is Tiger Woods, and you can go on and on and But in the world of investing, we know is Warren Buffett. So what has Warren Buffett done as an investor that made him so successful? It's that he buys great businesses, big cash flows, large economic moat, and he holds on for the long term. Right. So we all know this as investors. So talk to me about why is it important as an investor to be a long-term investor and not so much worry about, there's some redundancy in what we're going to talk about right now. I get it, but I want to just help people understand being a long-term investor and why that is beneficial.
Yeah, Phil, it's not necessarily what he does. It's what he doesn't do that maybe has led to his impressive track record. So you're right. What he does is he buys great companies after doing a lot of fundamental research, and then he holds them long-term. That's what he does. What he doesn't do is let short-term market volatility lead to an emotional response to abandon his strategy. That's what I think he does exceptionally well. He ignores the news of the day. He doesn't really care whether or not an analyst has upgraded or downgraded a security or whether or not the market is up or down this quarter. He tries to ignore those outside influences and stick with his thesis. So that's kind of why he's been successful. Look, the numbers are pretty compelling, Phil. I've got them. Being a long-term investor only increases your chance of a successful outcome. Phil, if I told you that the stock market, and I'm not just using stocks as the only asset class, but only as an example. If I invest in the stock market and a year from now, I go back and I examine my results. Was it successful? Was it unsuccessful? The odds are 55-45. If I commit money to the equity market today, the S&P 500, and I look back in a year, there's a 55% chance I've got more money than I started with. There's a 45% chance that I don't. 5 years. Well, the odds become very productive. 75% chance that my portfolio is up in value. Only a 25% chance that it's below. If I go out 10 years, Phil, the numbers are really compelling. It's 95-5. Yeah. Over a 10-year horizon, and this is what I'm sure Buffett considers in his approach to investing. The longer my investment horizon, the greater the probability that I will enjoy the rewards of the asset class that I've chosen to allocate to.
Yeah, that's I want to close on that. I think that's really terrific. So, John, is there anything that I didn't discuss that you would like to tell my audience?
I think our audience knows many of the best behaviors. It's applying them. That's maybe the greatest challenge. You've hit on a number of them today, Phil. Number one is to have a partner who's well-educated, but maybe most importantly, can help guide us during periods of emotional volatility. Number two is to take a long-term perspective, because as the numbers suggest, being a long-term investor only increases my odds of a successful outcome. Number three, it's to diversify well, to spread those risks and to reduce the drawdown and the volatility that often leads to bad behaviors. I think these are some of the tried and true methodologies that can help our clients stay on track and enjoy the successful outcomes that they hope to achieve.
John, this has been really, really, really terrific. It achieved my goal of what I wanted to have you on and why I wanted to have you on for my clients, most importantly, prospective clients and any family and friends that are listening in. So thanks for your time today. I really, really appreciate it.
Our pleasure. Thank you for having us.
Thank you.